A marketplace for opportunity zones can help unlock billions of dollars in capital to help revitalize neighborhoods all across America and provide much needed housing. And my guest today will explain why. Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson, and joining me on the show today is Todd Vitzthum. He is president of ACARA, a national real estate brokerage and capital markets firm. And he's also the co-founder of OZ Listings, which we'll be talking about quite extensively on the show today. Todd joins us from the Bay Area in California. Todd, great to have you on the show. Welcome. How are you?
I'm great. Thanks, Jimmy. I'm honored to be here.
Honored to have you here with us today. Todd, you and I go way back. I guess we've known each other for a couple of years now. You were one of the first members to join my OZ mastermind group, OZ Insiders. And we're going to talk about your new platform, OZ Listings, throughout the course of today's show. But first, I want to get a little bit of background on you in case any of our audience may be unfamiliar with you or your brokerage firm, ACARA. Can you tell us a little bit about yourself and ACARA before we dive in today?
Yeah, I've spent a little over 20 years in what I would consider to be corporate, institutional, commercial real estate on the brokerage side. I grew up in a small town in Iowa. I was part of a technology company in Denver that moved me to California. And when the dot-com bubble burst, I ended up getting into commercial brokerage. And I always say the best and the worst thing that ever happened to me was I had success in brokerage. I stayed the course. I ended up running some platforms for big companies like CB Richard Ellis and Cushman Wakefield. And when the capital market space really started to integrate with the brokerage space, when a lot of the big, what we think of as traditional debt and equity shops started building out brokerage companies, I was kind of front and center in that world and worked with a few of those groups. But I ended up going to work for a national agency lender out of New York called Greystone. I ran their Northern California office, and it really changed the way that I thought about the brokerage business by adding debt and equity. So, after spending 5 years at Greystone, we went out and we started our own platform. We started a national brokerage company that is brokerage, debt, and equity. My partner is a real estate attorney. We have offices open across the country, and pretty much everything we do is oriented towards the multifamily space, but we've kind of honed in on ground up development. That became my specialty practice coming out of the GFC, and I just kind of stuck with it. Most of my clients are big national developers or regional developers building housing ground up. And that's what led me into the opportunity zone space. As you and I have discussed many times before, the vast majority of opportunity zone deals are ground up development. And it's a little bit of a complicated category of business and real estate to navigate. So we've really embraced that. We've built a national specialty practice group for development and development as it relates to opportunity zones.
Very good. And yeah, opportunity zones, the way that the statute was written, it really requires ground up construction, ground up development in the vast majority of cases. The whole purpose of the tax policy is to incentivize the creation of new opportunities in opportunity zones, revitalization, new jobs, new buildings. There is a caveat if you're able to substantially improve existing buildings, or if you're able to tear down vacant buildings and then redevelop. There's also a case for business development or moving a business into a zone or starting up a new business in a zone. But the fact is that I would estimate 90% plus of all opportunity zone capital is going into new real estate development deals. I want to ask you more about development and what makes development unique in real estate in a minute, Todd. But first, I want to kind of rewind a little bit and get back to your career in the real estate brokerage industry. I'm just curious, you've been in the industry a little while. How have you seen it change or evolve over the course of your career? What's different now than it might have been when you first entered the field?
Yeah, no, that's a great question. And listen, there's a lot of, I think, misunderstanding or mystique about the commercial brokerage industry, right? It's kind of perceived as an old boys club. But after spending 20 years on the inside, my takeaway is I always say there aren't really commercial real estate brokerage companies. There are marquees with a bunch of independent contractors working underneath that marquee, building their own individual businesses. So that, the industry loves that independent contractor status. So the need to work at a big institutional firm has kind of lost its luster a little bit. I spent 15, 20 years in that space working in a big glass building wearing a tie every day. And then I realized this was just my business that I was building. And we finally took the leap and went out and built our own platform, built our own model. We're like more of a holistic service provider. Everything we've done has really been oriented towards the client, building a better service model, understanding what they need. And in the development world, what developers need is they need access to land development opportunities, and they need access to capital. They need access to equity to build those product to build that product. So that's kind of how we've evolved. The industry is a little bit stuck in that mode of kind of the one tool in the toolbox. A lot of brokers, the question is, do you want to buy or sell? And if the answer is no, then they'll call you back in 6 months to see if you want to sell. But we like to look at our clients' entire portfolio. We look at what should be sold, what shouldn't be sold, what's depreciated, what is cost segregated, what needs to be financed. And then on the development side, we're very focused on providing those direct investment equity resources to fund those projects so that they get built.
And within the OZ space, I mentioned a moment ago, the vast majority of OZ deals are development deals, but there's a little bit of a unique aspect of development. How is development so much different from a lot of other real estate plays? What makes
If
development so special or hard or challenging?
Well, there's a perception of the risk profile that the average investor really has a hard time just understanding or getting their mind around. If you're a country club style investor, accredited investor, a lot of that capital flows into the syndication space, right? Syndicators traditionally buy older apartment buildings, they fix them up, they identify an arbitrage in rents, they raise the rents, they raise the value. But that creates an abundance of capital flowing into that category of business. If you say development to the average investor, they immediately equate it to a story of a development deal they heard about that went sideways and everybody lost their money, right? So it is a slightly higher risk profile than buying an existing deal, but the correlating rewards, if done and done right, more than offset the risk. And we've become experts at identifying the best development opportunities in the country, the best sponsors. And at the end of the day, my investment thesis, my belief, where I invest my money is, it makes a whole lot of sense to build and hold long term and to own things at a cost basis and just fully depreciate those assets and almost treat them like a piggy bank where you're just having capital events through refinancing through the life cycle of that deal.
I
So
would think sorry to cut you off. I would think that a lot of what goes into making a development deal work is de-risking it at the front end. So what are some ways that you mitigate risk before you step into a development deal?
well, as my partner Jeff likes to say, it's the teamwork that makes the dream work. And the number one way to de-risk any venture, particularly development, is you got to work with the right people, right? If you work with the right people, anything's possible. If you work with the wrong people, you might as well not even get started. So the first thing we do is we have a whole criteria that we use to qualify developers, right? And if you're working with some of the best, most high quality developers, and these are groups that their families, their generations who have been in the development business, their balance sheet clients who a lot of times are using their own capital to build and hold these assets long term. They're not there's anything wrong with merchant building, but they're not the traditional merchant builders, which are more of a fee build model. So, we look for those developers, and I've literally worked with hundreds of developers across the country And you get to a point where you can identify them pretty much immediately. And then, as Richard Koch says, find someone with a complementary skill set, like-minded integrity, align your interests, and you've got a partnership. So we put structures together with those developers that bring them what they need, which is capital stack services and access to direct investment equity. And we do it in a structure that's very favorable, first and foremost, to the investor, and second to the developer. And we like to create these long-term partnerships. And when you're working with a good developer and you develop that relationship over time and you work together to guide your investment goals with their production model, that is how you de-risk development, as opposed to just going out trying to model and underwrite a development deal that meets a certain threshold financial criteria, and then doing that deal and then going out and doing it with a different sponsor in a different market. So I believe in long-term programmatic partnerships with the best developers, and I would qualify that as probably less than 10% of the overall developer market, not because those other developers aren't good and have a high level of integrity. It's just a different model, and it fluctuates significantly geographically between, institutional markets and non-institutional markets where, historically capital has moved into those through big funds like Blackstone and Carlyle.
But we haven't seen a lot of big funds like Blackstone and Carlyle invest in the OZ space. I want to ask you about that in a minute. But first, let's talk about the OZ layer strapped onto a development deal. Development's already a multidisciplinary type of real estate investment. You really need a good team. Different parts of the team can handle different facets of a development deal, but then you layer on top the opportunity zone part of it. How much more does that complexify
Well,
that issue, and how do you resolve that?
it's not insignificant, and the way you resolve it is you bring together the right team of experts, right? That's the answer. But most development deals, and particularly opportunity zone deals, start with a landowner or a sponsor who has a deal and they realize it's in an OZ, right? And they're already having a difficult time taking that project through entitlement, defining something that is of highest and best use, creating efficiencies, all the things that they do as developers. And then you've got to go out and raise the capital, which has always been a challenge for developers. And then every deal, because of how opportunity zones are structured, has to be a fund. And when you start talking about funds, and you know all about this, Jimmy, when you start talking about funds and the compliance and the SEC component and the penalties associated with doing it and doing it wrong, not every development deal outside of an OZ has to be a fund model. Every deal that is built as an OZ has to be a fund. There has to be a qualified opportunity zone fund that invested to a qualified opportunity zone business, which is the special purpose vehicle, which is the deal itself. So that that component alone is enough to drive a lot of people away from ever starting in the opportunity zone space, right?
And is that why there isn't more institutional capital in OZs? Why do you
Well,
think it is? Because I just made that statement a minute ago. First of all, is it true? Is there not a lot of institutional capital in OZs? And if that is true, why isn't there?
it's really designed well for the direct investment client who is going to experience that tax mitigation benefit, right? The entire premise of opportunity zones has shifted the way we've driven capital into real estate. Historically, under previous administrations, we were taxed, and then we created governmental subsidies to support the production of affordable housing through what, from an insider's perspective, was a very inefficient and expensive process. And now what we're doing, which I think is brilliant, is we're creating this market environment where the free market works by creating incentives for high net worth investors and family offices to move into this type of development. So it's really built for the direct investment high net worth investor family office, right? And when you look at institutions and how they've historically participated in development, there's a fund that's created, there's a joint venture that's structured with that development sponsor, and the developer doesn't necessarily like that model because their deal becomes the fund's deal, and that deal is sold based on the duration of the fund. I always say it's like the fund dog wagging the real estate deal, the fund tail wagging the real estate dog. Um, and so, institutions have just a completely different focus based on where we're at in the market cycle. One of the reasons we're not seeing a lot of institutional capital move into OZ development is we're off cycle. There's not a lot of institutional equity moving into development at all. Most institutions are writing down, the last cycle development fund, and they're building a new fund to acquire distressed assets, right? Just not their own. So where we're seeing the big institutions move into these markets is to pick up the completed projects at a basis that's at or below the cost. So they're just not focused on development right now. And even when they are, they're primarily focused on core markets that aren't necessarily correlating with institutions to build the most feasible projects. And it just doesn't really correlate with the overall OZ structure. Now, there are some great pseudo institutional firms participating in the OZ space, and we've talked about a few of those that are really, really good, but they're kind of few and far between.
Yeah, I think that's right. Some names that come to mind: Cantor Fitzgerald, Griffin Capital, Argosy, Origin Investments, great
Bridge and
examples as well.
Origin,
Bridge,
and
Bridge,
yeah,
absolutely. Yeah, Bridge might be the
yeah,
biggest one of the bunch there. Absolutely.
yeah.
Should there be more distressed asset OZ funds? Is it possible to put together something like
So
that to acquire
yeah,
distressed assets in a qualified opportunity fund? That's an interesting
so
idea.
that's a very topical item of discussion for us because in general market terms, we're coming out of a very, very unique market cycle triggered by the ultimate black swan event of all time, which was COVID, right? And we all know that COVID created an economic shutdown, which forced the government to create liquidity, which created inflation, which created a correlating rapid rise in interest rates. So every project that was under construction across the country, modeled to a 5.5 yield on cost, designed to exit at a 4 cap, found themselves completing these projects in a 5.5 cap market, right? So if you do everything else right, you build to a 5.5 yield on cost and deliver in a 5.5 cap market. Well, it's worth what it costs you to build, right? Your profit margin is eroded through the cap rate fluctuation. So, we are now watching all of these development deals come out of the back end of production, really valued at or below cost, right? So when you look at those deals that are in opportunity zones, the first thing you have to do is you bifurcate them into those that were previously structured as OZ deals and those that weren't. And if you have a deal that was built in an OZ that was not structured as an opportunity zone deal, there's that magic little window of what we all know is pre-C of O, right? And you get the first time use designation, and that project can transact and be sold prior to certificate of occupancy. And we've worked on a few of those transactions, and it's a way to fully monetize your distressed asset through disposition. Now, I'm working with a couple of, I think, some of the best minds in the OZ legal space to talk about rebuilding capital stacks post CBO. You can bring qualified opportunity zone funds, new qualified opportunity zone funds, into an existing qualified opportunity zone business, pre or post C of O, as long as you're within that safe harbor window. So we are actively working on projects right now. There's one case study. It's a pre-C of O project, but we want to rebuild the capital stack, bringing new equity into that deal. So there's a mark-to-market event that's beneficial to the new investor. The previous investors will most likely get diluted. The development sponsor will retain the imputed equity they have in the deal, but we're bringing in a new equity infusion. This is a market that we're really embracing because it represents a mitigated risk profile for the new investor. You're buying into an existing deal with near-term cash flow. You're not experiencing all of the risk and cycle risk of a ground-up development deal. So we're quickly becoming experts in this space. I'm putting a whole team together for this, and we're actually going to go out and really try and create a marketplace for this distressed opportunity zone category.
And I referenced a marketplace in the intro for today's episode. And I want you to tell me now about this marketplace, which is OZ Listings, which you're developing with your team. What is it and why are you building it?
So we're building it. The short answer is we're building it because I went out there and looked for this because I needed it and I found it didn't exist. So I started talking to a lot of kind of thought leaders in the space, including you. And we really needed a marketplace, and we needed a marketplace that was a community where everybody involved in the opportunity zone space could participate. And all the service providers, I on the real estate side am focused on bringing deal flow into the marketplace. But really, what we want to do is create a resource center for investors. If you've had a capital gain and your traditional advisory network doesn't really understand how to effectively navigate it, even if they do from a legal or tax standpoint, they don't have access to deal flow, right? They don't have access to good deal flow. So my job in this model is I'm sourcing and listing and bringing good, high quality deal flow. I say the best sponsors and the best deals in the country that are in an OZ, that are in the OZ category. I'm bringing them into the marketplace. And we want to bring investors into the marketplace where you can look at something and have just the context of, the problem if you are an investor, first of all, what do you do to source deal flow, right? Do you go to a broker? Do you look on LoopNet? Do you talk to your brother-in-law who knows a guy who syndicates deal at the country club? We wanted to create this marketplace for opportunity zone deals and create an educational arena where you could understand how it works for compliance, how it works for deal vetting, how it works for joint venture structuring. So, we started, and I think a lot of times when people start a business, it's like climbing a mountain. You have no idea how big the mountain's going to be. But we've built this incredible team. We're launching this marketplace. I'm actively sourcing and vetting some of the best deals in the country. And really, what we're finding at the end of the day, Jimmy, is that my new mission has become I want to take traditional real estate developers who are really, really good, who haven't really embraced the OZ business, and bring them into the marketplace so that we can have really the best developers and the best deals. A lot of the cottage industry that's been created by opportunity zones is, developers have emerged in the opportunity zone world that weren't developers before because of this unique ability to raise capital, right? And some of those are great developers, and some of them are just new without a robust resume. But I'm going out educating the real estate community on the benefits of OZ and trying to bring in the best sponsors. And we're doing all of this to really create a more welcome environment for the investor. So that's and you're a big part of this. I mean, you are kind of one of the one of the thought leaders in the industry. You certainly attract an enormous following. So it was just a natural transition for us to do this with you. And I think, we've got this incredible team, and now that we've got a lot of support for this under the new administration, I think this is going to grow into something that's just better and better and bigger and incredible.
Yeah, I'm excited to see where this goes, and I'm happy to help out how I can to see if we can drive a lot more investment activity into different opportunity zone projects and funds all across the nation. I don't want to give investment advice on this show, and I'm not asking you to give investment advice on this show. So that's the disclaimer for the next topic of conversation. But I wanted to ask you, Todd, how should investors view opportunity zones in their overall investment portfolios? I mean, you mentioned that a lot of their advisors oftentimes don't really understand the OZ angle. Maybe they understand bits and pieces of it, but a lot of times I feel like investors, a high net worth accredited investor who's interested in doing an OZ deal, their advisors don't know how to advise them. Now, I'm not asking you to give financial advice or investment advice, obviously, but
Yeah.
how should investors view opportunity zone investment products within their overall portfolio?
Well, I always say an OZ will make a good deal great, but it will never make a bad deal good. right. And so if you are, for instance, a family office and you've had a capital gain event, you absolutely have to think about the tax mitigation strategy through opportunity zones, because there are very, very good deals in opportunity zones, right? And they have to be at par or better than a market rate deal. You know, it's not like when opportunity zones started and everybody that owned a piece of dirt in an opportunity zone immediately thought their land was worth twice as much. It doesn't really impact the fundamental metrics of the deal itself. We have to hit targeted threshold yield on cost fundamental or metrics, and we need that, we need that IRR that's consistent with any other investment opportunity. I believe that the benefit of opportunity zones belongs to the investor, right? The benefit to the developers, they can access a source of capital that may not otherwise be there for their project, but their project has to be good. And the way we qualify any development deal, first and foremost, is we use a little bit of cowboy math. That project built, we have to build to a 5.5 or 150 basis point yield spread above the current cap rate environment. So if you're in a 5.5 cap environment, we need a 7% yield on cost, untrended, for that to be a qualified, viable, feasible development deal. Where, you know, if you ask 5 people today what the cap rate environment is, you get 10 different answers. Nobody really knows, but you know, we do know that we need at least 150 basis point yield spread to build ground up, right?
That's yeah, I think that's right. That's what you've taught me anyway. And I just think that ends up making the math make sense, makes the deal pencil because you do need some profit built in. Otherwise, what's the point, right?
Yeah,
Um,
exactly.
Part of the point of opportunity zones obviously is to produce a profit, and it incentivizes tax-free gains on your investment deals. But another big part of opportunity zones is this policy initiative that the federal government is trying to attack. And one thing that they wanted to do when they created opportunity zones was to catalyze the development of new businesses in
Yeah,
these
yeah.
zones that typically lack private investment from venture capitalists, let's say. But what it's ended up turning into is something that I think Congress and the policymakers back in 2015, 16, 17, when they were putting this together, they maybe not have envisioned how big this would be for real estate. And I think what the policy is ending up doing instead of creating a lot of businesses is creating a lot of housing all over the country. Novogradac just came out with their year-end 2024 numbers. And
Hmm.
according to the figure that they are tracking, over 198,000 housing
Yeah.
units just in the funds that they are tracking have been developed or are scheduled to be developed through qualified opportunity funds that they're tracking. Now, Novogradac admits they're only able to track roughly a quarter to a third of the overall qualified opportunity fund universe. So, extrapolating that number from there, about 200,000 housing units is what they're tracking, having been developed or about to be developed. I estimate well in excess of 600,000 housing units, possibly as many as 800,000 housing units have been or will be developed by the funds that have been invested in qualified opportunity funds to date.
Hmm.
If this program gets extended more, I mean, you can imagine this program could result in millions of housing units being created. And it's a real dismal state, the housing issue in America today. We are several million units behind in terms of attainable, affordable housing for Americans all over this country. Homelessness is a real problem in this country. Housing affordability is a real problem in this country. If OZs can attack that issue even just a little bit, I think it'd make a huge difference. But how do you view the role of opportunity zones in addressing that problem?
Yeah, well, I mean, it's a big, big part of it, right? And you and I have talked about this before. There's an underlying mission here that we really believe in. I truly believe in the structure of opportunity zones, creating much needed housing and economic development in underserved communities, right? And I think with this new administration, I feel like it's about to be day one in opportunity zones, right? We've gone through the learning curve. We've all kind of figured out our niche, in the service industry, it's like putting a puzzle together. There's 15 different people that are required for every deal, and we're kind of finding each other. But now we're about to get this big boost from the current administration, and I think it's really going to come together. And I think we're going to be able to create an enormous amount of housing by bringing the right type of capital into the right projects with the right sponsors and the right team. And we're just going to be able to facilitate this entire process. And it's one of the most topical issues in our country right now is affordable housing. And if you look at, like we talked about before, how we have created the subsidies to create affordable housing, you just can't subsidize your way out of a housing crisis, right? It's almost impossible. It would take so much money to build all these homes. And at the end of the day, supply creates affordability, right? We just need to create supply. And I'm of the mindset that, this works and works so well that, let's just create this incentive for all investors. Let's get rid of the cap gain requirement. Let's get rid of the opportunity zone map. I mean, what if we just did, you know, incentivize the placement of private capital into the development of housing, period, right? That to me would solve our country's housing crisis faster than anything. And it's a very, very challenging problem to solve. Opportunity zones, I think, represent a chance to put a major, major dent in that. But we need to add, to your point, a few million units across the country just to keep housing costs in tandem with inflation.
Yeah, it's a big problem. Opportunity zones alone probably won't solve it, but I think it'd go a long way toward addressing that crisis that this nation faces. Todd, it's been a pleasure speaking with you today. We're just about out of
Yeah.
time, but before we go, we talked about OZ listings briefly a few moments ago. If there's any listeners or viewers out there who are interested in learning more about OZ listings, first of all, what can they do if they go to OZ listings? How do they get to OZ listings? Tell us a little bit more about it.
Well, ozlistings.com. And we've built this as a marketplace that, everyone can come. It's a resource center to provide access to service providers, to educational content. We're kicking off a weekly call, which is just going to be industry experts talking OZ at a high level. And it's really designed to speak to the investor. If you've had a capital gain, if you're delaying a capital gain because you don't have a tax mitigation strategy, we invite you to reach out to us. I'm easy to find. I'm a broker. I'm a lender. I want people to find me. So go to myacara.com, go to LinkedIn, go to OZ listings. There's a very nice little 2-minute intro video, Jimmy, that you recorded on the homepage of OZ listings, which explains it perfectly. So yeah, if you're in the OZ space, if you've got a deal that you want to talk about, if you're a sponsor that is a traditional development sponsor that wants to understand more about how to move into the opportunity zone space and source that type of capital, or if you're an investor and you're just trying to figure out how to navigate the space, that's kind of what we're here for.
Perfect. Well, again, Todd, thanks so much for joining me today. And for our listeners and viewers, I'll have show notes available at opportunityzones.com/podcast. And there I'll have links to all of the resources that Todd and I discussed on today's show. And please be sure to subscribe to us on YouTube or your favorite podcast listening platform to always get the latest episodes. If you enjoyed today's episode and you're on YouTube watching us right now, give us a like, give us a thumbs up. Would really appreciate that. Todd, thanks again for joining me today. Really appreciate your time. Thank you so much.
This is awesome. Thank you so much, Jimmy.